Welcome back. And today, what I want to unpack is a question that sits at the heart of private equity M&A and really capital allocation more broadly. And this is how value is created. And because, again, if we're honest, value creation in private equity and M&A has never been just about how deals are done. It's also been about changing cash flows, changing risk, and changing what somebody's willing to pay for those cash flows at exit. And this has always been the game. But what has changed and changed quite meaningfully is which levers matter most. In the past, which levers matters most, and how easy or difficult those levers are to pull. Again, historically, private equity could rely more heavily on leverage, on tax shields, on governance discipline, and in some cycles even multiple expansion. And in M&A, the classic logic was scale consolidation and cost synergies. But today, that playbook is much less dependable. The environment is more demanding. Debt is more expensive. Entry prices are still very high. Exits are less certain, and that means value increasingly has to be built operationally, not simply bought financially. And this is the core message um, of this series that I want to cover around value creation. If we go back to the classic private equity model, especially in the 1980s to 1990s, the dominant levers were much clearer. The model heavily relied on financial engineering, governance engineering, and operational engineering, but financial engineering had predominantly played a particularly strong roles. Buyouts were often financed at very high levels of debt, ranging from between 60 to about 90%. And this leverage created tax shields and amplified your equity returns and imposed the discipline on management and management teams because the business had to generate cash. Then, of course, came governance, smaller boards, closer oversight, faster decision making, stronger incentives, and in many cases, management change happened quickly if leadership was not aligned to the value creation plan. And that tighter governance was often part of the value story in itself. And then operational improvement followed. Not always very glamorous, often difficult, but rationalization plans, improving productivity, sharpening working capital, financing, refocusing portfolios, and in many deals, the real value came from forcing difficult decisions that public ownership had delayed. So the historical private equity module was not just buy cheap and lever up, but leverage certainty did much more of the heavy lifting than it can today. Now, one of the most important lessons from the 2000s is that easy credit can create a illusion of skill. So when credit was abundant, leverage rose. But again, the evidence suggests that leverage was often driven more by credit conditions rather than underlying quality of business. And importantly, higher leverage tended to be associated with higher transaction prices and lower fund returns. So in simple terms, when money is easy, people tend to overpay. And this really matters because it reminds us that leverage is not value creation on its own. It's an amplifier. So if you enter well, manage well, and exit well, leverage can magnify those returns. But if you overpay, or the cycle turns, leverage can just as easily magnify that mistake. And this is why price is always a central point in private equity and M&A. And you can be operationally right and still financially wrong if you pay away that upside at entry. And this was true historically, and it remains true now. And a classic example of this is RJR and RJR Nabisco, and this reminded us that even great sponsors can destroy value when they purchase assets becomes disconnected from what can realistically be created post acquisition. So one of the first lessons for the market today is that financial structures help, but price discipline still sits at the center of that value creation. Now, we also have to then consider moving from sort of the 80s, 90s, and early 2000s, what has changed between sort of after 2010 and especially after 2022. So if we kind of fast forward a era, roughly from the 2010s through to the late, just before the 2020s, many deals benefited from supportive rates, significant liquidity in the market, and various other tailwinds. But the environment has shifted, and the market today is telling a very different story. Cheap debt is less available now. Again, we've got inflation pressure, and again, questioning for how far rates can come down. Rates are likely to increase. Multiple expansion is less reliable. Holding periods can be longer and has been longer, and exit timing is definitely harder. And that leads to what we could call the new maths of value creation. So if you cannot rely on cheap leverage and easy re-rating, then more of the return has to come from revenue growth, from margin expansion, from productivity improvement, capability building, and really disciplined execution. We saw this also from a few reports from coming out early 2026, pointing to this, that in the current environment, deals may need roughly 10 to 12% average annual EBITDA growth to hit the benchmark 2.5 times return over 5 years. I think this came from the Bain report. And again, that's a very different underwriting mindset from the old days when structure and multiple uplift were doing more of the work. And that really changes everything. It changes the diligence, it changes management selection, it changes what board needs to focus on, and it changes what kind of sponsor or buyer is likely to outperform. Now, if we then start looking at what this operational value creation really looks like, and sitting at the center, this is where the conversation really becomes very, very practical. The operational value creation is no longer this nice to have layer added after the deal. It has moved to the center of the investment case. And that means in improving commercial performance. It means getting the pricing right. It means fixing procurement. It means driving working capital discipline, digitizing processes. It means using data AI more effectively. It means building management capability and governance cadence that actually deliver that plan. And of course, the evidence supports this. Research on buyers show that value creation often comes through reallocation, restructuring, and productivity improvement, not simply financial packaging. And more recent work also shows that LPs are paying less attention to whether sponsors have genuine value creation strategies and operational capabilities, not just a good financial deck. They really pay attention to the value creation, the investment thesis, and the operating capabilities of the sponsors. So today, the best investors are not just your capital providers, but they're increasingly operating partners, capability builders, and really execution managers. And for businesses, that means that the bar has really risen. If you're looking for investment or positioning for a sale, you cannot just tell a growth story. You have to evidence the operational levels that make that story truly believable. If we look at this context, if we look at this from an M&A perspective, and again, this is the evidence here is equally revealing. One of the most persistent findings in M&A research is that an announcement target shareholders tend to win far more than the acquirers, the shareholders. So the classic evidence shows that target shareholders earning around 16% abnormal returns around that announcement window, while acquirers on average hovered around zero or slightly negative. So combined value can be positive, but the seller often captures a large share of that value upfront. And this is a very powerful lesson to learn. It means that in M&A, the buyers usually has to earn back that premium after the deal is signed. And in other words, value creation for the acquirer does not happen at signing. It happens in integration, synergy capture, operating redesign, and executing after close. So this meta-analytics work also suggests that acquirer performance on average is mixed, and it can even be modestly negative, which reinforces just how much execution really matters. So when corporates say they are doing a strategic acquisition, the question is not whether the rationale is good. The question is whether they have the operating systems to convert that rationale into cash flow, and that's where many deals succeed or fail. So here too, if we want to elaborate on that, if the seller really captures all the value quite early, then the acquirer's battleground is very clear. It's the synergy realization. And again, and I think this is where many boards and management teams underestimate that challenge. Cost synergies are generally more controllable. Revenue synergies usually harder. Capital synergies can be meaningful, but require very clear discipline. And in each case, integration design matters. Too little integration and you leave value on the table. Too much integration, especially in revenue sensitive businesses, and you can disrupt customers and talent and really momentum in the business. And this is why I often say that acquisitive businesses need a repeatable M&A operating model, not just deal ambition. So you say you need a synergy baseline, you need owners, you need milestones, you need clear governance, you need day one clarity, you need a disciplined integration management office, and you need honesty about what actually bankable versus what is simply optimistic. So the modern acquirer that outperforms is not necessarily the one doing the biggest deals. It's often the one that has built the best repeatable synergy muscle. And this very much speaks to M&A capability built into the DNA of the organization. It's also important, I think, when we speak about value creation, to think about bolt-ons, buy and build, and some of strategic roll-up value. So here too, I think one of the most interesting overlaps between private equity and M&A today is this rise of bolt-ons and buy and build strategies. Why is this the case? Well, bolt-ons are often one of the most practical ways to create value. They allow buyers to add capability, consolidate markets, deepen their reach, and really improve platform economics. And there's also great evidence that suggests that private equity firms pursuing buy and build strategies can still generate above average equity returns, even when they pay upfront a strong platform for a strong platform asset. But again, it only works if integration is treated as a core capability. Bolt-ons can look attractive on paper because each acquisition seems manageable, but when multiple integrations are running at once, the real strain shows up in the system, the data, the culture, leadership bandwidth, and of course also execution fatigue. So the strategic message here is important. Bolt-ons are not just a deal strategy; they are operating strategy. And for businesses, this means that building assets that can serve as a platform. For investors, it means underwriting not only acquisition opportunities, but integrating capacity. And for management teams, it means recognizing that serial M&A requires institutional capability, not ad hoc heroics. In addition to this, there's also a few newer dimensions to value creation that matter much more today than they did historically. Digital and AI are no longer really side conversations. They are increasingly part of margin improvement, productivity, commercial presence, and even exit readiness. Investors are re-underwriting businesses based on whether technology capability would improve that cost curve or make the asset obsolete. Then, of course, sustainability. Historically, governance has always mattered, but your environmental, social factors and climate factors were less standardized and often treated as peripheral. And this also is no longer the case. ESG is increasingly influencing fundraising, buyer appetite, financing terms, and exit readiness. And there's also evidence that suggests that environmental and social incidents can reduce a private equity firm's ability to raise subsequent funds. Again, so a very interesting point to point to note, specifically also with sustainability being integrated across the organization. Um, and then, of course, there's the quality itself in a market where multiple expansion cannot be just be assumed. Higher multiples increasingly need to be earned. And this means recurring, very much a business model discussion, recurring revenues, customer retention, strong data, resilient margins, leadership quality, governance discipline, credible reporting. And again, for those interested, also linking very, very closely to sustainability around many of these factors. Around it's a business model discussion about how are you managing your business in a sustainable way, that your business model is being renewed and that it remains robust. So the modern value creation agenda is much broader than what it was. It's more operational, more data driven, more governance sensitive, and more dependent on whether the business is actually becoming better, not just better financed. So as we kind of close this, what this really means in practical terms is for investors, whether private equity or strategic M&A, you can no longer rely on market tailwinds to do the work for you. Underwriting has to be more explicit. You need to separate what comes from EBITDA growth, what comes from margin improvement, and what comes from deleveraging, and what, if any, might come from multiple change. And frankly, you should be able to make the deal work even if multiple expansion never actually shows up. Of course, then for businesses and management, the implication is equally important. If you want to attract capital, command a premium, or position for a successful sale, your equity story has to be grounded in strong evidence, not just strategy slides, but measurable transformation, strong earnings quality, operational readiness, digital capabilities, ESG discipline, and integration preparedness. Of course, where relevant. And for boards and management teams, this is perhaps the biggest shift of all, is that value creation is now less about financial packaging, but more about this execution infrastructure, the capability built around the teams involved in M&A quite early on in the process when this thesis is developed. In the planning phases, in the execution phases, and of course in the integration phases, and then when you start actually executing. So this really means that the winners in this area is likely to be those who can turn ownership into performance, and integration really into measurable synergies, and your strategy into cash flows. And this really is my view on where value is actually created, and how sustained value creation is created. Thank you for listening.